we continue right now with our next presentation. So Harej will explain, we'll talk about the optimization in reinsurance. So please, Bor.
Thank you, Jasna. Sorry, Lisa, can I ask you to stop sharing?
Stop?
Yes.
Okay.
All right. Okay. Welcome everyone who is listening. So my name is Harej. I'm working for Primary Solutions. It's a company which is based in Switzerland, in Zurich, in Zug. It has a bit more international. And I would like to present today reinsurance optimization service that we are providing together with the tool. So it's mainly a service since it's a lot of knowledge behind that. So first of all, I would like to start why reinsurance, because maybe for some of you this is basic idea, but just to put the whole picture together. So let's say that we have kind of a company. Through time, we expect always, if it's a healthy company, we expect the capital to grow. So there will be some kind of positive profit through each year, and there will be some increase of capital through time, and this will support increase of some growth of the company and so on. So this is usual traditional way. But what we see is the first green line is a kind of an average, but in the reality, the business goes more like this. So especially in insurance, we know that the premiums, of course, and the expenses are quite predictable, but the claims, especially the claims, might be quite volatile, and it depends, of course, from the risk taken. But there will be some good years where some special events didn't happen. For example, like some cut events, like flood, like hail. On the other side, we have years with the claims which were more exaggerated, more heavily, and so the real capital actually is not exactly average, but it jumps up and down. And this is fine, and this is part of the business. Of course, the reinsurers take this into account, but still, the problem can be here if there is some limit to what extent this can be volatile process. So if there is one limit when we say, okay, in this case, if the sensitivity, this change is too high, we fell below zero, before some threshold, and in this case, this might mean problems for the insurance to work. So even being negative or being taken by the regulator, so this is not the process that it can be as much as volatile as it can, and here comes into account reinsurance is the major tool to lower this volatility around expected value. So just a quick overview. What are the basic forms of reinsurance? Let's say that we have two major types of products. One are proportional, and this proportional can be split to two types. So first type, if this box presents either individual claim, which I'll call X, or aggregate loss, so together all these individual claims together aggregated in the annual loss S, we have two types. One which is basically targets individual claims, so this is called surplus, and the one who is targeted on the whole portfolio, which is called quota share. So the surplus usually is used for just largest individual exposures. For example, for houses, it's not used for fire protection, for example, but for the companies as in total, which are big exposure, can be used. and works in a similar way. So similar way like quota share, so you always cede one proportion of the premium, and then also the same proportion of the claim is also paid. So that's why it's called proportional. And here is the only parameter, especially if you're talking about quota share, the only parameter which is used is alpha, which presents how much of the premium and claims is ceded to the reinsurance. In surplus, of course, there is additional parameter which will not focus that much in this case, which is what is the starting point of the policies coming into, and this is then defined. Then, if we look at if we have proportional, we have non-proportional, and this works a bit different. So here, if we go again looking into the claim loss in the same different aspects. One aspect is being individual claim X, and the other aspect is being aggregate loss through the whole year S. So if we have individual loss, we are talking always about so some share part of the loss that the insurer will accept, will hold, and there will be part of the loss that the insurer decides to cede to the reinsurer, and this is defined by the limit, and from the loss above again goes to the reinsurer. This is per type per loss, and this can work, for example, for individual claims X. This is called excess of loss. If there is an individual loss of some big fire being, I don't know, 5 million, the insurer might decide that, okay, all losses individuals should have a deductible or priority at 2 million. So deductible and priority can be used two different words. And until then, this loss is paid by insurer, and then what is above 2 million, for example, for another 5 million, this would be covered by reinsurance. And if this is altogether 2 plus 5 is breached, what is above that is still again paid by insurance. So this is called limit or cover. So the part in between is protected. The same works stop loss, which used on an aggregate loss. For example, the insurer might decide, okay, I want to my maximum portfolio or a segment loss should be 100% of the premium. So I would like to limit my loss not to be bigger than 100% of my premium, and I would like to protect it for another 100% of the premium. So if there will be 300% of the premium loss in one very exceptional year of some segment, it means that the insurer will keep the first 100 and the last 100. The 100 in between will be covered by the reinsurance. This is the agreement. So this is usually called limit excess of deductible or cover excess of priority. So now the question which comes is, so let's have, this is our in the vertical line, we present expected result, and our company is right now here. So we have now two teams, and one team comes with additional project which would suggest, okay, if we will do this project, we will increase our expected result in the next year. And then comes another team and says, okay, we have another project, but this one would decrease our expected result. Another question is, which team would add value to our company? Of course, the first thought would be, of course, the one gives expected result is a positive. So the obvious answer here is yes, one adds a value, of course, and the second one destroys the value. However, as from the beginning, what we are talking about is this sensitivity. Do we have all the information here? So what now if we look also with the risk? So, okay, one company or one project brings different higher expected result and the other one is decreasing one, but what they bring in terms of the risk. And it turns out that this is actually goes in this way. So The first one actually, yes, increases the expected result, but increases the expected risk even more. On the other side, the second one decreases the expected result, but decreases expected risk even more. So if we now look at in the comparison, so as the ratio of both those two, so like where we are now in terms of this ratio between expected result and the risk, we see so-called RORAC. We see that risk adjustment return on equity on capital. We see that actually this is the opposite. So the first one destroys value because it destroys this ratio between the return and the risk. And the other side, the second one increases the value because we will more surely get actually less profit, but more surely get that profit. So and this then raises the question, yes, we are optimizing the portfolio, but to respect to what? In the same sense as we presented in this example, we say, of course, if we start from this 0 point and we say, if we can increase here, I presented here on the vertical and on the horizontal line, two things in so-called SCR. For example, it's the solvency capital requirement. This is now the measure of risk for insurers, and the risk-based capital is some kind of a value of a capital right now. So if it's definitely a bad luck. It's really not a good business to go in this direction. So where we increase the risk and we decrease the capital. So this is really a no-go. On the other side, if we manage to go into other direction, this is a Santa Claus. So this is a really good direction. We are reducing the risk and increasing the return. So this is a perfect direction. So these are two fields which are really usually not really accessible if are especially the left one, left upper one. This is a great one. So actually, what we are doing is in these other two fields, and here is on the top right is what is called insurance. So the insurance is taking additional risk from the policyholders in return for some profit. So the insurance is increasing its risk and expected return in the same time. On the other side, here is the reinsurance. So insurance pays a little bit of its profits, shares the profit with the reinsurance in terms to decrease its risk. So this is our fields now of the optimization. So we try to reduce with the reinsurance. We are going to the left. Okay, so what are the objectives? So why would someone do such an optimization analysis, looking at all different spheres? Because reinsurance structure is usually quite a complex structure in insurance, with insurance, especially more mature and growth insurance. They have many different programs for different line of business, which were set at the point when this line of business was created, and then were a little bit adjusted. But in terms of a portfolio view, might not be optimum, or it might be some already not updated correctly, so it didn't really follow. So it stayed the same way as it was initially created, even if the company grew and developed and changed. So the first thing is to evaluate the current program. So where we are now, what brings each of these individual programs to the whole picture. And this is important to see the effect on the risk of each of these. So also have a diagnosis of a technical result. So is this profitable? Is this expensive? Each of these programs is expensive, is not expensive. And then once you do this, you can really understand, as I said, as I already mentioned, so you can understand the differences of the risk. So which part of the program brings a lot to the risk reduction, and of course also to the profit reduction. So you can really see these ratios by each individual unit in the reinsurance program. Of course, usually, especially non-life insurance, the program is renegotiated every year. So this is a continuous process, and there are usually not major changes done because it's insurance usually, and also reinsurers try to keep it, try to not change too much, try to keep it continuous and predictive. But still, if you have information, you can say you can always say, but look, this is something, this is too much, or this is too little. So you really have some information about what is going on behind. And beside that, you can validate actually the price you get from the reinsurance. So you can see, because you can see from your own data if that's really correct, and you can influence that. And of course, the main step now from this current situation on is to really look at the different structures that are there possible, because you are, as an insurer, you used to do something because you were at that point when you build up, this was the main, the better, the best kind of best practice. But these things develop through time, and you can really quickly somehow and easily check different reinsurance structures, and in some sense, in this sense, also optimize the reinsurance program. And of course, the last but not least is you can steer your primary business because you know the whole picture, not just on the gross values, because usually insurers look primary from the gross value, and there is different team who looks on the net values. So you can really see in the net values what is the business, how valuable is the business. So you can really push into the better ways. Just who are the stakeholders here? Of course, the reinsurance team is one who is dealing always all the time with that. Actuarial and the risk team. Actuarial is the pricing or reserving, and the risk team is looking on the perspective of the risk. And the sponsors here, of course, chief underwriting officer, chief financial officer, and chief risk officer. So now let's have a look at the one example how would look like this gross and net distribution. So let's say that this is the kind of gross distribution of the result we expect of one company. So somewhere like mean result being here. So this is kind of expected result around a bit less than 20 millions. And what is now the risk? How we consider the risk? Typically, we take some percentile, which can be VAR, which can be tail VAR, different perspectives, but like a solvency has a VAR 99.5. And so the risk is just the difference between those two. So the distance from the expected result, what we have in plans, usually planning is unexpected, and then the distance in something like extreme event, this would be our risk. And the rest will be the return, so the mean will be the return. Now what happens when we put the reinsurance on top? So the reinsurance you are paying, as we said before, the insurer seeks some of these profits to the reinsurer in return to reduce the risk, that this fat tail probability. So you can notice now that the distribution doesn't have a tail almost any longer, and but the expectations are lower now. So we reduced the expectations of our profit. However, we reduced also the distance between our VAR or tail VAR, so this percentile, and the risk is now much lower. Okay, so now how we plan. So we are looking in the future, always also solvency, also other all around the world. We consider usually the solvency schemes in insurance take into account 1 year perspective. So we are planning. We are today, and we want where we'll be next year. So if this is our capital, for example, or expected result, we are planning where we are going to be next year. So if you take a strategy with the reinsurance, we expect to be here. So this is something like maybe not taking reinsurance into account. Then if you take more insurance, we decrease the tail, you can notice, but still our expected capital will be here. And then the third result, which will be more conservative, more stable, will be lower. So we are putting out our expectations, but we are reducing also the risk where we're going to be in the one year time. Okay, now let's have the same logic about this strategy in the terms of risk and return as we saw it at the beginning. So, for example, if this is our portfolio today, we make an analysis. We look at different perspectives, different types of reinsurance structure, and we realize if we do this, we can move in our space. So this is how we do the analysis, and this is if we do the circle, this the line on the edge of all this possibility is something what is called efficient frontier. So here in this case we are maximizing the possibilities of the result and the risk, and these are actually the results on this line are actually interesting for us because this is kind of an optimum. And so what we are now trying to select is these strategies on this optimum. So one being further away with the risk, one being a bit lower, and the second here. So this is what we are trying to optimize, and this is the core when we are searching the space of a return and risk. Of course, the insurance can have additional limitations especially about the risk. Maybe the capital available is limited, so we cannot go further than in some direction to the risk. So we have to limit that way, or some other. But in general, this is the story. Okay, so let's have one example of reinsurance optimization. Let's say that this green dot is our situation of current situation of the company right now, and now we implement the stop loss. Stop loss, as you remember, this is a program that can limit the loss on the portfolio level or on the segment level. And when we play with these two parameters we have, so one is the priority or deductible, and the other one is limit or cover, we get this space. And you can notice, of course, one is here on the line with the blue line. This one is kind of optimum, and we say, okay, let's have a look what happens here. And this is a typically what you see with the standard deviation. So we can keep part of the risk as the insurance part of the risk. This blue part is seeded, and the rest is again really unlikely risk. So we keep it for ourselves. And this is kind of one example what is an optimum. And then we ask ourselves, but look, there are some dots there very to the right where actually we also increase the risk even using reinsurance. How is this possible? So you really you can actually increase the risk using the stop loss, and this happens in actually this is the example where you actually change the role. So actually you sit the most stable business. So you actually revert to the reinsurance, and you actually sit all stable business, but all the risky part you retain. And this turns out to be where you actually increase the risk and even pay for that. So you don't want to go. Okay. So now, how is the generic optimization tool architecture? So how this whole process looks like? So first of all, we start with the data. Of course, the major data are company data about claims. So this is the crucial information, individual claims for the past I don't know, 5-10 years for different segments, to get statistics, to get the nature of the claims, to get to learn about how these segments work. So this is in this stage also the segmentation is done. So how are these different claims different in terms of how they develop, how the amplitude to which distributions goes? Is this more related to nat cat, so or just property? What is the tail and exposure of these claims? So the second step is putting these claims on level. So it means that they are statistically comparable. This is mainly means taking into account market data, macroeconomic environment, so especially inflation, some other product changes, some additional deductibles, and so on. So to make these claims really comparable for modeling. Once we have that, it's the calibration. So in this step, all different segments are calibrated. Usually, you do this in the three types of claims. One is the CAT claims, like natural catastrophes, which are specific in the sense that they are small, but they happen in the same time. Then the individual large losses for some big exposures, and all the rest, which goes into like an aggregate model for attritional, so smaller claims. And the same thing is then to simulate GOT losses. To do that, we need to combine them and to model also dependency between these segments or between the type of claims. So this is the first part of the process. And once we have that, we have what is called mostly an internal model. So this stochastic simulation model, having premiums, expenses, and the gross losses as the key random variable aggregate. So we get this result as we presented before. Now, since the reinsurance is not usually done on the same segmentation as we have these losses, the best way, we first need to aggregate in the sense to take into account the reinsurance. For example, reinsurance for MTPL is usually done all together, so the claims come together. But sometimes the claims originate from bodily injury, and claims originate from material damage in the motor third-party liability, can be modeled separately, but the reinsurance takes into account the total loss. So first we need to aggregate these sections. And again, we use this correlation, so that these dependency structures, copulas, to model that. Once we have that, we apply the current reinsurance structure. Every company has by everything this program, and then we can actually come to real cost. So the tricky here, so we come to the net position of course the net distribution, but also the trick is how to calculate the estimate of reinsurance, the cost of reinsurance, because if we want to simulate different reinsurance program, one of the key problems here is, but we don't know the price, so the price of the reinsurance. And to do that, what we do is we use existing reinsurance and we estimate what is the cost of capital based on some measure. The measure can be VAR, can be variance, standard deviation, some loading. So we use the existing to measure that, and we use them consistently for different reinsurance. So we say even if you change the insurance, we have some kind of similar approach to the reinsurance. So we should have similar cost of capital, which is used for pricing their insurance. So this is used, and then we generate many different reinsurance processes. So this is this tool is focused in this sense that it can really look at a lot of different insurance, and this is done quite quickly, so that we can really find an optimized reinsurance for us, and to understand why and how one of them impacts and how they impact the result. Okay, now let's look at the result, how we see, what can we learn from such an analysis. First of these results is so-called ant plots. And why? Because we are trying to come from the existing reinsurance, so from the how it would be without reinsurance to what we have with current reinsurance program, and how much each of these individual parts of reinsurance program, what each of these brings to the whole picture. So for example, if this is what would be a gross without reinsurance, gross position, gross risk, and that would be kind of so RORAC here. And if we would have finally a net position, it would be the other dot. So this is a net position. Now, and we have now, for example, in this scenario, in this portfolio, 4 types of programs. So general third-party liability, quota share, property, excess of loss, not cat excess of loss, and MTPL stop loss. Then we can see that first effects like that, and then the second one, property has this much of effect, and not cat has this much of effect, and the MTPL stop loss has this much effect. If we look under with a bit more closer, we see this. So coming like that. So now, what can we learn here? We can learn that, for example, MTPL stop loss reduces mostly the risk and affects the least effects. So the effect to the return is the smallest. So this is apparently the most effective. On the other side, if you look at property Excel, is not really effective. So it just takes the return away, but the risk is more or less doesn't have an effect. So this is what we can learn from the current program. What are the importance of each of these programs? The second types of plots is a spider plot, where we again start, but this time we start from the net position, current net position, and we make a sensitivity analysis on each of these individual parameters. So we play with the excess of loss priority, and we keep the rest fixed. And then we play with property excess limit, and we keep the rest fixed, and so on. And what we get is something like that. If we look in the closer perspective, we get like that. So if we make a sensitivity, we move into different directions. And then what we can learn from this one is that, for example, this one would be the best selection, because it goes more to the left, and even in this case, even increases the profit. So this is kind of trying to optimize from the current position. The first one was to understand how much it brings current result, and now we can already optimize and try to where can we go. And then there is a third type of plots, which is sponge plots. And here what we do is we generalize the sensitivity analysis, not just one parameter to more than one. For example, to the whole property Excel, where we randomly make a sensitivity analysis to both parameters, or even to the whole scope, so whole reinsurance, all parameters in the same time. So if we do just, for example, property Excel, we get something like that. If we do the not cutting together, we get something like that. MTPL stop loss in so both priority and cover, we get something like that. And if we do all of them together, we get something like that. So that's the analysis. And again, we get what will be the best solution here to see the optimum. Okay, this is what I had to present. So what we have here is, as I said, it's our service, and of course we have a tool which is also made in Excel in total, but also made just as a interface Excel and Python. And Python, the core is made in Python to really enable fast simulations. And this is the reinsurance is usually an important part of the business, and the optimization might with small optimization we can get very significant financial results. So that was my part. Thank you very much.
So thank you, Bor, for this lecture. I would like to ask the attendees and all the panelists, are there any questions, remarks, comments? So if you'd like to ask, either raise your hand or write it into the Q&A or chat. So there seem to be no questions. So I would like to thank you again for having this presentation. Is there anything that you would maybe like to emphasize before we conclude regarding your work?
So this is yeah, as I mentioned, this is a process usually when I'm working for consultancy, and usually what was in the past very common is to selling the tools, and the tool, and with the mind that the tool will do everything.
Mm-hmm.
But then it turned out that the tools were sold, but the results didn't come because the tools are one part, but the knowledge how to use the tools are much more important.
Mm-hmm.
And that's why I'm saying yes, here what we are providing here is not the tool itself. The tool we give for free at the end of it, so you can play with that. But the most important part is implementation, and this is the core part. That so you really get that done, and that quite quickly. Actually, this can be done in the relative short amount of time, usually a month or 2 months. And you compare, and if you compare this to the price of reinsurance, and the reinsurance is usually it's quite heavy, so it's maybe 10, even more than 10% of the non-life business, for example. Then if you can optimize and save some portion of this, you can already get quite a significant financial benefit. So, and if you start with just the tools, then you by yourself you are developing this and learning, and it takes ages, and then at the end everyone really comes something. This is my experience. So that's
there is one question in chat. Did you receive it? I guess you did. More.
Let me. How can I accept that? Sorry. So nice presentation. Do you have some concrete solutions to determine optimal reinsurance for line of business according to the types of insurance? Here is of course, if you talk with underwriters, reinsurance underwriters, they have some kind of feeling for that, knowing which line of business are more appropriate for someone, and or in which phases of the company some programs are more. For example, quota share is usually used when the company is growing, we doesn't have enough capital, but then we go more and more to the non-proportional once you have the company established bigger, or some faculties. But the idea here is different. So the idea is not looking just from the perspective individual line of business, because individual line of business, you can judge the risk on the individual line of business limitedly, because it's impacted by the size of the portfolio where you have. So if you have many line of businesses, if you can afford higher risk actually on one line of business. If you don't have enough, you have a monoliner, then you cannot afford this much of risk. And that's the whole point of this analysis. So you are not looking from individual loss perspective, but you are looking from the perspective of the whole portfolio. And this what you gives, and this is what a kind of approach that gives you the real value. So and that's the main problem, because usually you are always looking into account only one line of business, but then you are missing out the opportunity to use the portfolio diversification benefits. So this is as much as I can say about that.
Okay, thank you. Are there any other questions, comments, remarks? So doesn't seem to be the case. So I would like to thank you again for I would like to thank you again for your presentation. and then see you after the lunch break. So we have the lunch break, and the last presentation will be from Diego Clavian, which will be at 2:20 p.m.